There's something almost cruel about trading psychology. You can spend weeks crafting the perfect plan, building your rule set, fine-tuning every detail to keep your emotions in check. And then, in one heated moment, you throw it all out the window. That's the paradox of trading. The battle isn't just against the market, it's against yourself. Most traders know what they should do, fewer actually do it, and the gap between knowing and doing is where accounts are quietly bled dry. Let's be honest, rules in trading are easy to write down. They sound good on paper. I'll only take A-plus setups. I'll cut my losses quickly. I won't chase. But when your heart's pounding, when the chart starts moving fast, when you've just taken a loss or missed what looks like a perfect entry, those same rules suddenly feel negotiable. You start rationalizing. You bend a little here, stretch a little there, and before you know it, you've completely abandoned your system. That's why this problem isn't about strategy, it's about psychology. Every trader who's been in the game for a while has lived this. You're sitting there, staring at the screen, and deep down you know this isn't the trade you planned for. It's sloppy, it's forced, it breaks your own criteria. But something inside whispers, just this once. And in trading, just this once has a nasty habit of becoming a habit. To understand why most traders break their own rules, we need to dig deeper than charts and setups. This isn't about candlesticks or moving averages. It's about human nature, the way our brains are wired to respond to uncertainty, loss, and reward. And it's about building mental structures strong enough to resist that wiring when it matters most. Because the difference between consistently losing traders and consistently profitable ones isn't that the winners are smarter. It's that they've learned how to not sabotage themselves. When a trader writes a rule, they're trying to anchor themselves in logic, a kind of pre-commitment to rational behavior. But when the market goes live, the brain doesn't operate in pure logic. It runs on emotion, fear, hope, greed, and sometimes even revenge. Think about it like this. Writing your rules is like drawing up a battle plan on a calm morning. But once the first shots are fired, that plan is tested against chaos. One of the core reasons traders break their rules is that their emotional threshold hasn't been trained to match the volatility they're facing. Imagine someone who writes in their journal, "I'll accept a $200 loss per day maximum." It seems reasonable in theory, but when they actually lose $200 and that red number stares back at them, their brain doesn't calmly accept it. It goes into fix-it mode. I'll make it back quickly. One more trade. That emotional reaction is stronger than the logic of the rule itself. This is why rule breaking in trading isn't about lack of discipline in the abstract sense. It's about an emotional mismatch between what you said you'd accept and what you can actually tolerate in real time. You can't brute force discipline if your emotional pain threshold is lower than your rules demand. So, instead of fighting your brain, you have to train it. That's a completely different game. Let's unpack a typical cycle. A trader creates a set of rules. At the start of the day, they feel confident. But then, the first trade goes wrong. Emotions spike. Suddenly, that well-written plan doesn't feel like a guardrail anymore. It feels like a straitjacket. The temptation to just fix it becomes overwhelming. And here's the trap. In that moment, the brain convinces you that breaking the rule is the rational choice. You don't think you're doing something reckless. You think you're solving a problem. That's how most rule breaking happens, not through obvious recklessness, but through subtle rationalizations that sound logical in the heat of the moment. There's a famous quote often attributed to Mike Tyson. Everyone has a plan until they get punched in the face. Trading is the exact same. Your first loss of the day is the punch. How you react to it determines whether you stay a professional or slide into amateur mode. This is where the difference between amateur and professional traders becomes brutally clear. Amateurs rely on willpower. Professionals rely on structure. An amateur says, "I'll be disciplined today." A professional builds systems that make indiscipline harder to execute. For example, a pro might set automated stop losses, fixed daily loss limits enforced by their broker, or a structured checklist that must be ticked off before every entry. They don't trust their emotions in the heat of the moment. They build guardrails to protect themselves from themselves. But even structure isn't enough without awareness. Because here's the thing. Most rule breaking starts long before the actual trade. It begins with a small shift in emotional state. Frustration after a loss, excitement after a win, boredom during a quiet market. These little emotional ripples slowly chip away at your rational mind until you're more susceptible to impulsive decisions. Professionals recognize these shifts early. They step back. Amateurs ignore them and end up acting on them. A powerful analogy is thinking of your trading rules like the safety ropes on a mountain climb. They're not there because you plan to fall. They're there because you will slip at some point. When emotions spike, your logic weakens. That rope is what stops a slip from turning into a deadly fall. But for a lot of traders, when emotions spike, they unclip the rope instead. They convince themselves they can climb the next ledge freestyle. And most of the time, that ends the same way, with a painful drop. Another major factor that leads to rule breaking is identity. Most traders subconsciously tie their sense of self-worth to their trading results, so when they lose, it doesn't just feel like losing money, it feels like being a loser. And when ego gets involved, rules become negotiable. You'll do anything to win again, not because the setup is right, but because your ego demands validation. That's why professionals work on separating their identity from their performance. A losing trade doesn't make them a failure, it's just data. It's feedback. And feedback doesn't require emotional retaliation. This is also why revenge trading is such a powerful and destructive force. When your ego is bruised, your rules aren't a priority anymore. Your brain is on a mission to restore its sense of control. It wants to get even. But the market doesn't care about your feelings. It doesn't owe you a bounce back. And most of the time, that attempt to get back what you lost is the exact moment your account takes its biggest hit. So how do you actually stop breaking your rules? You can't just say, "I'll try harder." That's like telling someone in a panic attack to just relax. It doesn't work. You need systems that operate outside of your momentary emotions. One effective method is building in physical friction between impulse and execution. For example, some traders deliberately add extra steps to their entry process, like physically writing down why they're taking a trade before hitting the button. That extra 20 seconds can be enough to bring your rational brain back online. Another powerful approach is pre-mortem planning. Before your trading session, visualize the exact emotional scenarios that usually make you break your rules. Maybe it's taking 3 losses in a row. Maybe it's seeing price move without you. Whatever it is, rehearse how you'll respond to it before it happens. That way, when the storm hits, you've already practiced staying anchored. You should also deeply question the emotional expectations behind your rules. If you set a daily max loss of $200, but can't emotionally handle seeing $200 down, then your rule isn't realistic. It's just a fantasy. Align your rules with what your emotional system can actually withstand. As your tolerance grows, you can adjust them. But trying to enforce rules that outpace your emotional capacity is a guaranteed way to break them. And of course, none of this works without accountability. Trading in isolation is one of the easiest ways to slide into self-sabotage. When no one's watching, it's easy to negotiate with your own rules. But if you have some form of external accountability, whether it's a trading buddy, journaling, or even a coach, you're far more likely to stick to your commitments. Professionals understand this. Amateurs prefer to hide their mistakes in silence. There's also something to be said about the pace of trading. Overtrading is often a symptom of rule breaking. You take one bad trade, then another, and before you know it, your whole rule book is in flames. Slowing down is one of the most underrated skills in trading. If you've ever noticed how the best traders sometimes do nothing for long stretches, that's not laziness. That's discipline in action. Think of your trading rules like seatbelts in a car. You don't put them on because you plan to crash. You put them on because the road is unpredictable. Breaking your rules might not burn you every time. Just like driving without a seatbelt doesn't guarantee a crash every ride. But when it does happen, it's devastating. And most traders only learn this after a big account wipeout. The truth is, rule breaking in trading isn't about intelligence. Many traders who blow up their accounts are smart, capable people. The problem isn't knowing what to do. It's doing it consistently under pressure. That's why mindset, structure, and emotional awareness are more important than the fanciest indicator on your screen. As we dig even deeper into this, let's examine the psychological triggers behind rule breaking more closely. One major trigger is tilt, a term borrowed from poker. Tilt is the state of emotional agitation where logical decision-making breaks down. In trading, tilt often happens after consecutive losses or a missed opportunity. You start operating from your emotional brain, not your rational one. And on tilt, your rules are just background noise. Tilt can be sneaky. Sometimes it's loud and obvious, slamming the desk, swearing at the chart. Other times, it's quiet. It's the little voice that says, let's just take a small trade to feel better. And that quiet tilt can be even more dangerous because it disguises itself as rational thought. Recognizing the early signs of tilt is one of the highest return skills a trader can develop. Tilt has layers. The surface layer is usually frustration or disappointment. You're annoyed at the market for not behaving the way you wanted. But underneath that sits something deeper, a loss of control. The human brain hates losing control. It's wired to fight it. And when traders feel that their control over the situation is slipping, their instinct is to grab it back. That's when you start breaking rules to force the market to cooperate. You chase moves, increase size, trade without confirmation, and each of these actions pushes you further away from your plan. Think about it like trying to force a jammed door open. The more you push, the more resistance you create, the more exhausted and irrational you become. Trading is the same. The harder you try to control the market, the more it exposes your lack of control. That's why the best traders often look calm even when things aren't going their way. They don't try to force outcomes. They accept what's happening and act based on their plan, not their panic. Another sneaky trigger is overconfidence after a win. It's easy to assume rule breaking only happens when traders are losing. But in reality, winning streaks can be just as dangerous. After a few good trades, your brain starts whispering, "You've got this." You feel sharp, in control, maybe even invincible. That confidence feels good, but it also lowers your guard. Suddenly, a setup that doesn't quite meet your criteria feels good enough. You take trades you'd normally pass on. You risk more than usual. And then, when the inevitable losing trade hits, it's bigger, it's faster, and it hurts more than it should have. That's the trap. A small slip after a big win can erase hours, sometimes days, of good trading. This is why emotional regulation is just as important after a win as it is after a loss. Professional traders treat both scenarios the same way, neutral. They know the worst decisions are often made when emotions, positive or negative, run hot. You might not even feel like you're on tilt after a win because it feels empowering. But empowerment without discipline is just ego in disguise. Here's another uncomfortable truth. Most traders break their own rules because, deep down, they never truly committed to them. Writing a rule down is easy, but living by it, even when it hurts, is hard. Commitment means sticking to your stop even when price looks like it's about to reverse right after hitting it. It means not taking a trade even when your gut is screaming, "This is the one." That kind of commitment isn't built overnight. It's trained through repetition, pain, and self-awareness. That's why you'll often hear successful traders say things like, "You have to respect your plan more than your feelings." Because the moment you start negotiating with your rules, they stop being rules and become suggestions. And suggestions are optional. That's not trading. That's gambling dressed in a strategy. Let's look at this from another angle. Imagine a pilot flying a plane. They have strict protocols for every scenario: takeoff, turbulence, emergency landings. If something goes wrong mid-air, they don't just wing it because they feel confident. They follow the checklist, step by step, even if their instincts are screaming otherwise. Why? Because instincts under stress are unreliable. Pilots trust the structure, not their panic. Traders, in many ways, are pilots of risk. But unlike aviation, trading has no co-pilot. If you break your protocol mid-flight, there's no one to save the plane. This brings us to another key idea. Trading rules must be tested and owned. Many traders adopt rules they've copied from someone else, a YouTuber, a Discord group, a trading book, but those rules were built for someone else's psychology, not theirs. So when pressure hits, those rules don't hold, they crumble, not because the rules are bad, but because they were never emotionally theirs to begin with. That's why building your own system, even if it's simple, is so powerful. When your rules are yours, you're more likely to defend them. And here's where journaling comes in, not as some boring afterthought, but as one of the most underrated tools to stop rule breaking. When you write down every instance where you broke a rule and, more importantly, why you did it, you start seeing patterns. You'll notice that it's often not the setup itself that triggered the slip. It's what happened before the setup. Maybe you were already tilted from an earlier trade. Maybe you were trading tired. Maybe you were trying to make back losses too fast. These patterns become your personal red flags. The moment you start recognizing your red flags in real time, something shifts. Instead of being swept away by emotion, you start to catch yourself mid-swing. You hear the thought forming, just this one time, and instead of acting on it, you step away. That pause is where real discipline is built. Discipline isn't the absence of temptation, it's the ability to see it clearly and choose differently. A useful analogy here is a traffic light. When you're about to break a rule, your mind flashes a yellow light first, a warning. If you ignore it, it turns red, and by then, it's usually too late. Most amateur traders blow through yellow lights without realizing it. Professionals learn to spot them and slow down. But let's address the elephant in the room. If sticking to rules is so important, why do even experienced traders still mess it up sometimes? Because trading is a probabilistic game, and humans hate uncertainty. Every trade has an element of randomness. You can follow your plan perfectly and still lose. That unpredictability messes with our survival brain. We evolved to seek patterns and control, not to thrive in randomness. So, when the market gives us an outcome that doesn't match our expectation, our brain scrambles to fix it, often by abandoning the plan that would have saved us in the first place. The real pros accept this randomness. They understand that following rules doesn't guarantee a win. It guarantees consistency. And consistency is the only foundation on which long-term profitability can stand. That's why they don't measure success by whether a single trade was a winner or a loser. They measure it by whether they executed their plan correctly. That's a subtle but powerful mindset shift. When you start grading yourself on process, not outcome, your rules stop feeling like shackles and start feeling like freedom. This idea may sound strange at first. How can rules give you freedom? Because when you no longer have to decide in every moment, you remove the emotional chaos from trading. It's like driving on a clear road with proper lane markings. You can focus on the journey instead of constantly second-guessing where to go. Rules aren't there to restrict you. They're there to protect you from your worst impulses. This is where self-awareness comes back into play. Most traders aren't losing because their strategy is bad. They're losing because their strategy never gets a fair chance to work. They abandon it halfway. They break it under pressure. And when that happens, they blame the system instead of the real culprit, their inability to follow their own rules. And this isn't just a newbie problem. Some of the best traders in the world have admitted to fighting the urge to break their own rules even after years in the game. The difference is they've built enough self-awareness and structure to catch themselves before they go too far. Amateurs think they'll one day stop feeling emotional pressure. Professionals accept they'll always feel it, but they build systems to trade well despite it. It's like surfing. You can't control the waves. They'll come how they come, big, small, unpredictable. The amateur tries to fight the ocean. The pro learns to ride it. Your rules are your surfboard. If you ditch it when the wave gets rough, don't be surprised when you get dragged under. So far, we've explored the why behind rule breaking. Now let's move deeper into the how to stop part, because awareness without action is just philosophy. To truly stop sabotaging your own trading, you need a structured approach that makes it hard to break your rules and easy to follow them. That starts with simplifying your rule set. Many traders make the mistake of overcomplicating their trading plan with 10 different rules, conditions, and exceptions. The more complex your rules, the more mental loopholes you create to break them. Simplicity is your ally. A rule like, "I only trade the first 2 hours of the day," is clear and hard to argue with. A rule like, "I'll trade when momentum looks good unless it's too choppy, except maybe on Fridays when..." That's a playground for rationalizations. Professionals keep their rules simple, sharp, and actionable, because when the pressure's on, your brain won't be able to handle complexity. It needs clear signals, not paragraphs of conditions. Another pillar of preventing rule breaking is pre-commitment. That means making your decisions before you're in the heat of the moment. It's easy to say, "I'll wait for the perfect setup," when you're calm, watching the market from the sidelines. But when you're staring at a chart that looks like it's about to run without you, logic evaporates fast. Pre-commitment creates a barrier between emotion and action. That can be as simple as setting your daily max loss in your trading platform so it locks you out automatically, or writing down your entry rules in plain language where you can see them every time you trade. Another powerful technique is public accountability, even if it's just to a small trading buddy or journal that you treat seriously. When you make your rules visible, when you know someone, or even just your future self, is going to see whether you stuck to them or not, it creates subtle pressure that can keep you aligned with your plan. Professionals understand they're not bulletproof against emotion, so they build guardrails. Amateurs think willpower is enough, and let's be real, willpower is a weak foundation for trading discipline. No one is at their emotional best 24/7. Some days you'll be sharp and disciplined. Other days, you'll be tired, frustrated, distracted, or overconfident. If your whole system depends on you being at your best, your system will fail the moment life gets messy. That's why structure beats willpower. You want your environment, your tools, and your systems to protect you from yourself on those bad days. There's a famous quote from Warren Buffett: "The chains of habit are too light to be felt until they are too heavy to be broken." When applied to trading, this cuts both ways. Good habits, built slowly and reinforced daily, become your armor. Bad habits, ignored and repeated, become your prison. Every time you break a rule, you make it easier to break it again tomorrow. But every time you keep a rule under pressure, you build a habit that makes it easier to do the right thing next time. This is why rule breaking is often less about a single moment of weakness and more about a pattern. Most traders who break their rules do it over and over in similar emotional states. The market doesn't make them do it. They've trained themselves to do it. But here's the upside. If you trained yourself into bad habits, you can train yourself out of them too. One of the best training tools is deliberate trading review. After every session, not once a month, not when it's convenient, sit down and ask yourself one simple question. Where did I follow my plan, and where did I not? Not how much money you made or lost, but how well you executed. Over time, this builds a feedback loop. You'll start to see clear cause and effect. You'll realize that your biggest drawdowns didn't come from your strategy failing. They came from you stepping outside of it. Another critical step is to define the consequences of rule breaking before it happens. Most traders don't. They wing it. And when they break a rule, they either beat themselves up or shrug it off. Neither response builds discipline. Pros attach real consequences. For example, if they break a trading rule, they might stop trading for the day or the week. They might journal the incident in excruciating detail. They might reduce size temporarily. The point isn't to punish, it's to make sure that rule breaking costs something. That cost makes it harder to justify the next time. But while structure and systems are essential, the deepest change happens at the identity level. You need to stop seeing yourself as a trader trying to follow rules and start seeing yourself as a professional who follows their rules because that's who they are. It's subtle but powerful. When your rules become part of your identity, breaking them doesn't just feel like a bad decision, it feels like being out of character. Think of a surgeon. They don't pick up a scalpel and say, well, maybe I'll wear gloves today. The gloves are non-negotiable. That's their professional standard. You want your trading rules to reach that same level, not negotiable, not up for debate, just who you are. This identity shift isn't instant. It's built by stacking hundreds of small, disciplined actions over time. Every time you resist the urge to break a rule, you cast a vote for the kind of trader you want to be. And as those votes accumulate, discipline starts to feel less like a fight and more like second nature. But here's the uncomfortable truth. You will still mess up sometimes. Even the best do. The key difference between amateurs and pros isn't that pros never break rules. It's what they do after they break them. Amateurs spiral, chasing losses, making excuses, abandoning their plan. Pros stop. They analyze. They take responsibility, and they use that failure as a data point, not a death sentence. They don't let one bad decision turn into a chain reaction. They cut the behavior at the root. Let's bring this closer to a real trading day. Picture this. You've just taken a clean setup, and it loses. You followed all your rules. Still lost. You feel that flash of anger. You want to make it back. Your brain starts whispering, double up on the next one. You deserve it. This is the fork in the road. Most traders take the emotional path. Pros take the structured one. A pro steps back, breathes, and maybe even walks away. They know their edge isn't measured in one trade but across hundreds. Another scenario. You're in a trade that hasn't hit your stop yet, but it's moving against you. You feel uncomfortable. Your instinct screams to close early or to move your stop further out. But your plan says to wait. This is where discipline lives. The market's testing you, not your system. The amateurs will tweak their rules on the fly to avoid discomfort. The pros will accept the discomfort to protect their consistency. There's a saying in trading circles, you don't rise to the level of your goals, you fall to the level of your discipline. That's why most traders don't fail because of poor strategy. They fail because of inconsistent execution. They say they have a plan, but in reality, they have intentions. Intentions don't make money. Execution does. When you treat your rules as flexible, the market will exploit that flexibility. It's like playing poker with someone who always shows their tells. The house doesn't need to beat you, you beat yourself. But when you become the kind of trader who treats their rules like oxygen, something changes. You stop needing to outsmart the market. You just need to outlast everyone who self-destructs. Because most traders will self-destruct. They'll take great strategies and burn them down with impulsive decisions. If you can simply not do that, you're already ahead. That's the real edge most people don't talk about. It's not some secret indicator or mystical pattern. It's boring. It's discipline. It's consistency. It's staying calm when everyone else is panicking, staying patient when everyone else is chasing, and staying structured when everyone else is improvising. And yes, this will feel hard. Following rules isn't glamorous. It's repetitive. It's uncomfortable. But that's what makes it so effective. The market rewards the few who can keep their heads when everyone else is losing theirs. Your rules are not chains. They're your shield. They're the quiet line between chaos and control. Every time you follow them, even when it hurts, you're reinforcing that shield. And over time, you'll notice something shift. The urge to break your rules won't disappear completely, but it will lose its power over you. That's the moment you stop being just another hopeful trader and start becoming a professional. If this video made you stop and think about your habits, that's progress already. Hit subscribe and let's keep growing as traders. One mindset upgrade at a time. I'm curious. What's your biggest mental win this month? Let me know in the comments.